Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in, take a look, and see what's going on today. If you want to follow me at Fair Finance, and if you want to join our community, findinghypervalue.com, I dive deeper into all these topics, looking for investment opportunities and sharing that all with the community. I do look for high leveraged plays for this commodity bull market that we are in. So if you're looking for the best vehicles, you can ask me during a Q&A session on the weekend what might fit your needs the best. Obviously, I have my favorites, and my favorites, a lot of them are very leveraged with a lot of volatility. But uh, there are other investments that may not be as volatile, or maybe you're looking for dividends or something on the lines of that. You just have to ask, and I'm more than willing to show you everything that I've got. Use special as the coupon code if you'd like to join. It's 50% off the first month only on the monthly membership, and a larger discount on the yearly. So the Coastal Journal, the Fed bought another 8.8 billion worth of 30-year bonds today. This is on top of the 34.8 billion it bought earlier this week. That's 43.6 billion in 4 days, not QE. And I don't know if they're actually doing quantitative easing. Quantitative easing means that more is going on their books than what's coming off. That would be easing. They're still doing quantitative tightening, but they're rolling over, I'm guessing, a lot of their bonds. So some of this could be rollover money of previous bonds that were already on their balance sheet. If they're adding new stuff to their balance sheet, then it would be quantitative easing if they are doing that. Coming down, Market Sniper. He's getting a little bit snippy here. I like it. He says, "Sure, Brent." This is Brent, the milkshake theory guy. He says, "Sure, Brent, that's why you never discuss unfunded liabilities in your debt percentages. It puts United States by Boston professors at a 600% plus debt level. That's also why China has 1.6% yields on its 10-year bond, and the US is priced at 4.3%. He says default risk. The market is so much less smart than you. That's why Besant is discussing cutting payments on foreign-held treasuries, a default, and no such discussion is had on China's debt. That is why markets are pricing and discussing U.S. debt default as your trade surplus blows out to records. Willist, China has surpluses and stacks gold with it. I think he means trade deficits. Net producer nations win out against end of hegemon, overcome sumer nations. Like, give up already. This guy has talked a U.S. hegemon wins out game, with China always more wrecked than the U.S. and keeps doubling down a second string Kyle Bass. So these guys are very bearish, Kyle Bass and Brent, on China. And when you look at it from the debt perspective, we have way worse debts here in terms of percent of GDP in America than China does. And this is what Brent said. Even if China's gold reserves are 7 times bigger than officially reported, China's banking system would still be more levered to its gold reserves than the United States banking system to its gold reserves. And they're kind of going back and forth, arguing about the debt in each of these systems and the resiliency of that system or economy. I'm not sure what to think of this. A lot of people argue this stuff. I don't know. I don't know what the end game is here. All I can say is I think that the debt in the system for America is going to cause the dollar to weaken against other currencies because of the debt levels that we've got. It will push the inflation from all of this stuff will push interest rates higher and cause a bigger and bigger problem over time. where we could see a stimulative effect from all the money printing coming into the system. It's going to be inflationary, is my guess. So these guys might be arguing uh, which economy is better, and capital controls and restrictions, and how easy it is for the United States to take advantage of its reserve currency status. There's all sorts of things that they can dive into. But all I know is I think we're going to see a weaker dollar at some point. I think they're going to do quantitative easing. They're going to buy back bonds. They're going to hold interest rates down, and it's going to put pressure on the United States dollar to go down. Other pressures are out there for other currencies and other bond markets, and we'll have to see which pressure is most on the currency to see which currency falls the fastest, is what I'll say. Coming down, Trump, you better go out and buy stocks now. Let me tell you, this country will be like a rocket ship that goes straight up. I'm sorry, guys. I thought it was funny just reading this as it comes in front as I'm scrolling down. Um, I had to share this. I don't think a president should be telling people that you better go out and buy stocks now. That seems a little bit over the top. But I will say that maybe they're back there with the plunge protection team and an unlimited money electronic creator, we'll call it. Maybe they're in there buying stocks. I don't know. But he seems pretty confident that stocks are going to go up. And maybe that's what he's measuring as success. And maybe that's what he's telling everyone around him to push, is to say, hey, push the stock market higher. I'm going to come out and say all this stuff. I don't know. RevCap says so on the deficit. It's going to be 6 to 7% deficit, assuming 3.3% interest rates, 3% GDP growth, and high tariffs, none of which will happen. What's the actual deficit? Could it be 9%? It's going to be big, so big. People have never seen anything like it, they are saying. So he's talking about the deficits. This is DB estimates a deficit impact on the one big beautiful bill. And this is the deficits minus 6-7%. But you have to take into consideration what the assumptions are. And, I did a lot of really difficult calculations and engineering. A lot of it deals with the assumptions or the given information or the assumptions made in the given information. I think that we're going to see ridiculous deficits. It's also going to be very stimulative. And why do we need these big deficits? Why do we need all this money printing? It's the design of the system. You must pump the system in ever greater quantities of cash so the system doesn't implode. There's always more debt in the system than there is cash, and you must pump cash into the system for the system design to survive. So the design of the system must pump money into the system for it to exist and survive. What's going on is that nothing stops this train, and that's Lynn Alden talking about this deficit. Nothing stops this train. So a lot of people are talking about a slowdown, a recession, and they focus on a potential decline. But the problem is they're pumping money because the system needs it. Pump, 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 pump. And people are saying, well, we could get that crash. No, we're pumping, guys. We are pumping the system. We are going to pump it like you've never seen before. Nothing stops this train because, so let me get this straight. Doge spent every day since January 20th working 20 hours a day, sleeping on the floor to find waste and fraud in the government. And the GOP is just like, nah, let's not vote on it. Can someone explain to me what's going on? Nothing stops. What's going on is nothing stops this train. You must pump. You can't stop. Otherwise, the system starts to implode. You get a deflationary collapse. So what happens is when you look at history and when countries get into this type of situation, they pump the system. because they don't want the system to implode backwards. Because once you start to get deflation, it starts to basically implode on itself. It eats itself alive. There isn't enough money for debts, and then it's basically like hitting the first domino, and you get a domino effect where one a few people default hits critical mass, and then it just blows out to everyone else because one person's debt default is another person's income. So what they rather do is just say, screw it, pump the damn system. Just pump it. Pump, 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 pump. So what I've done is it's like, okay, I'm going to be in inflationary sensitive assets because they're going to pump the system. Nothing stops this train. Joseph Philip Fair says, billionaire John Paulson is thinking gold hits 5K. Personally, I feel this might be on the lighter side by his date. But it's interesting to watch people start to pay attention, read what all John is thinking about on gold, and he's calling $5,000 gold. Some people are at 10,000, 20,000. I don't know where it will eventually end up. All I know is it's going higher if they're going to keep the system pumped. Gold's going to be the main benefactor of it. Gold, silver, probably platinum. Oil is going to be another main benefactor of this pump the system with money. Next stop for gold is 4,000, says JP Morgan, and it doesn't matter. It doesn't really matter what JP Morgan says. I really don't care. But this is what people are saying, and this is what they're sharing, so I'll share it with everybody. This is GDX versus XLF, which is a financial sector. So the gold miners have already broken the downtrend versus the financial sector. We will have one big hurdle at about a 1.15 ratio level, which we tagged again upon the breakout of the downtrend. So we've got the downtrend here. It's breaking out where GDX is outperforming XLF, and we'll probably see this work its way on up over time. And these are all big deals. When a certain asset outperforms another asset, we want to be in the outperforming asset. You won't get it right all the time, but a lot of the times what you'll have is you'll have one asset outperform and then another one bottoms and starts to outperform later. And they kind of go back and forth between two or three assets where one outperforms and then the other outperforms in an uptrend fashion. Higher highs, higher lows with consolidations. Market Sniper, a marginal minor increase of more than 300% plus. It's over for the U.S. debt hegemony. So U.S. Treasury will now need to borrow $514 billion this quarter, an increase of more than 300% from previous estimates. We need to borrow like heck to roll these bonds over, guys. We have a lot of debt rolling over. A lot. And again, nothing stops this train. Nothing stops this train. Being rich is having money. Being wealthy is having time. Margaret Beneno. What that means is that if somebody has to go to work and spend all their time working for money, yeah, you can be rich, you can have a lot of money, but you're poor with your time. Being wealthy is having time and using money for that time. So yeah, being rich is working for that money all the time. And then what a lot of people do is they try to show off that they're rich. They try to buy the cool cars, the big house, and that keeps them a slave to that money. Being wealthy is not having that slavery attached to a mortgage or debt or any of those things. You can do whatever you want, when you want, with whomever you want. Sometimes being really wealthy stinks because if no one else is wealthy with you, it's kind of like you're twiddling your thumbs waiting for other people to catch up. That also can happen if you play your cards right that you're dealt, make a lot of money early in your life, and then wait for everyone else to catch up. Because, it's fun hanging out with people and doing things with others. But let's just say you successfully navigated the markets quite well. Maybe perhaps you signed up to finding-value.com and learned how to invest and found a couple of the picks pretty good. It worked out pretty well over the next 5 years or something like that. And you're in your 40s or 30s, and you're looking for other people to hang out with, and they just don't. They're all working. They're all working their 9 to 5. Peter Sutherland, today is a sharp reminder of what can happen in energy land as tariff clouds lift. And it rhymes with Rip City. Beware the clickbait coverage calling for oil inventories to surge. Not every oil pullback is the big one, and OPEC won't launch a summer driving season price war. So keep that in mind. I don't think we're it. I don't think OPEC, if they bring on barrels, I don't think it's going to be that big of a deal. Everyone is so worried about this surplus that doesn't exist. And I like the what people say. Is this surplus in the room with us right now? We have low inventories. I don't think even if we ran surpluses, we're not going to fill those inventories up for many, many years. It's going to take a long time. We're also seeing supply in American shale start to pull back with the pullback in capital spend. So I'm not really worried about it. We'll watch it. We'll watch it together here on the channel. But a lot more people are far more worried than what I am, and I think we're seeing bottoming patterns in a lot of the energy companies, energy service and stuff like that. They look pretty good. APA, which is a company, so first quarter 25, I'm seeing USA crude oil production down 15% quarter over quarter from 148,000 barrels per day to 125,000 barrels per day. Don't think there's any dispositions in first quarter I need to account for. Am I missing something? No, I think it's just depletion and people cutting back with the price. Combination of those two things. Freight futures AM update. So dry bulk, Capesize is down 5%, Panamax is down 2. Tankers, VLCC is down 1%, Suezmax is flat. Here's Luke Groman. So a trade deal between the two biggest current account debtors in the world economy is like two drunks propped up against each other to stand. United States and the United Kingdom are the two big current account balance negative countries. Coming down, money wisdom. People who live far below their means enjoy a freedom that people busy upgrading their lifestyle can't fathom. And I think that deals with time and a peace of mind, says Naval Ravikant. He's a investor. That's how I live my life. That is how I live my life. My income from a variety of different things and dividends and all that stuff, my expenses are a fraction of what comes in. I don't have any debt outside of my mortgage, which is at a fixed rate of 2.75%. And my mortgage is really small. I don't have a lot of expenses. So I have this huge amount of cash flow. I can kind of do whatever I want with. I can absorb big problems if I need to. And it's a very good lifestyle because you don't have to worry about much. I never have to juggle where the next payment and where the next income for that payment is going to come from. You save, you invest, you get your dividend income up. Once you hit a six-figure income from dividend, and mine's across all the accounts, things become pretty easy if your expenses are a fraction of your dividend income. That's the whole point. That's the whole point of investing. The whole point of investing is to get in there, get money, get the dividends to pay you, your investments to pay you, and then you don't have to worry about money. That's the whole point of it. So that's where I'm driving, and that's kind of the outcome I think that I am basically living. It's years of savings, investing, growing it, and then buying cheap assets when they're out of favor. And now they're all going to start paying huge dividends out in the future here. I think it's going to get ludicrous. I think my dividend income could go up manyfold, manyfold. And that's kind of it's all previously thought out. Yeah, I'm riding through some volatility here with the tariffs. Had a pretty big pullback in the account for sure, but that's all part of the game. That's what you got to live with to go after some of this stuff. But I think in the future, some of these companies are going to be paying two, three, four times the amounts of dividends that they pay today. Uh, it's going to be big. HFI Research, lower 48 production, and he says, look at that decline here, guys. What's going on here for 2025? Look at that big sharp decline. Not looking too good. We're coming up into driving season. This better move up. Here's Grady. Has the main manipulation of gold and silver ended? Yes, I think the odds favor it has. In fact, been saying for a year that it broke 15 months ago when metals had their mega 13-year breakout, which he called obviously in real time. The proof for this, I think, in gold's character change since then, a runaway straight up move, huge move when broke free. The massive move gold has put in for the last year has been one of its strongest in history. And gold does not have one of the strongest moves it has had in history and then break the manipulation. That would not make any sense whatsoever. Furthermore, silver's move up the right side of that very large rounded bottom arc does look very normal. It is just stair-stepping up the right side of the rounded bottom arc. Same here. Silver does not break out above a 13-year trend line and resume the bull market in order to then pause at a very normal resistance at 32.77 in order to then break the manipulation. That does not make much sense either. It all happened at its 13-year breakout 15 months ago. Also, the fact that both metals broke out almost together above the 13-year trend line is further evidence for that it was the moment when the main manipulation was broken and ended. The synced breakout is really an amazing event in technical terms. Gold and silver are today the only counterweight as versus the global fiat monetary system. That is the reason metals were manipulated and seen from that perspective. One would really expect the powers that be to manipulate the metals, which they also have done for decades on and off. This because gold and silver rising hugely is a clear signal to the world that something is very wrong with the monetary system. It would really be misconduct from their part not to try and hold the metals down with that backdrop. Still, though, even without major manipulation, but with the present global fiat monetary system dying, it should be obvious not to expect this precious metals bull to be easy. Expect it to be hard, very hard. And do not get disappointed, i.e., emotional. Understand it instead. Getting the best guidance will be critical for the most in order to be able to make good use of this bull. Knowledge, experience, tools, and mindset will be key, as will ignoring bias, emotions, opinions, and narratives. Also, macro nowadays has way too many parameters for anyone to get directional right consistently based on that alone. Furthermore, the why to short-term moves is very seldom very interesting or even useful. That leaves us with the charts, which I think is the only real edge we have left in these markets. If done right, that is. Been saying since gold broke out 15 months ago that I think it will have a historical lockout move, not backtest the 13-year breakout. And it has not, which have locked many out of the move. We have prepared for this very probable outcome at the service from the very start, e.g., we bought the major lows for miners back in February of 24 heavily. Also said 15 months, think that gold will go 3,300 in this move. It's not even gotten to 3,500. So this is what we've got. Silver breaking out. We've got gold that's already been ripping. Guys, this move's in progress. It is moving higher. It's ripping higher. I'm not going and trading in and out of this stuff. I don't look at the relative strength indicator and say, oh, it's overbought. I'm going to sell it. I'm riding the big move. The big move is upon us. It's going. That's what I'll say. Here's platinum. So Another one from Platinum from David Morgan. I want to read through this real quick. He says, as of late in 2024, the estimated above ground platinum inventory is approximately 2.5 million ounces, which equates to about 78 metric tons. This represents a significant decline from previous years, with a 23% reduction in 2024 alone. And projections are indicating a further 25% decrease in 2025. How long will it last? Given that the annual global demand for platinum is around 7 million ounces, the current above ground stockpile would suffice for less than 5 months of consumption at present usage rates. The key considerations here are strategic stockpiles. A portion of the above ground platinum is held in strategic reserves, particularly in countries like China, and may not be readily available to the global market. Recycling limitations. While recycling contributes to the platinum supply, it is not sufficient to meet the growing demand, especially with increasing applications in the automotive and hydrogen sectors. Supply constraints. Major platinum producing countries, notably South Africa, are experiencing production challenges due to factors like aging mines and economic pressures, potentially leading to further supply shortages. The conclusion here is the current above ground platinum reserves are limited and declining, with less than 5 months worth of supply at current consumption rates. This scarcity, coupled with increasing demand and supply constraints, underscores the potential for significant market impacts in the near future for platinum. I love it. I love it. The numbers are not adding up. This is for crude oil. APA cut its annual capex by 150 mil, and Occidental cut its annual capex by 200 million. Diamondback Energy already cut its annual capex by 400 million. This is expected to accelerate the U.S. shale production decline that was already underway before this oil price drop. U.S. shale producers are reacting faster than expected. There will be opportunities on the back end, trade accordingly for oil. Oil's coming up here. It's gonna, I think, turn the corner here. And that's all I've got for today. So that's where we're gonna end it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Use that special coupon code. We've got a Q&A session coming up on Saturday at 7 a.m. We'll see you guys there. Catch you next time. This is Finding Value.